All right, welcome back to the Double Play channel, where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. Today I'm going to be talking about why cap rates on indexed universal life policies are so low right now. And I'll give you a clue. It doesn't have anything to do with the insurance company trying to screw you over. But this is important because a lot of people have a misconception about indexed universal life. They think that the returns are supposed to track the performance of the market index, but that couldn't be further from the truth. So if you're interested in learning why the cap rates are so low right now, stick around after the intro and I'll break it all down for you. All right, thanks for sticking around. I'm Tomrutkowski with Innovative Retirement Strategies, and this is the Double Play channel. I came up with the concept of the double play on my own many years ago, leveraging the cash value of a maximum overfunded life insurance policy to invest in real estate. And I thought that this concept was so powerful that I really wanted to share it with the world. So the goal of this channel is to not only share that with everybody, but to also dispel a lot of the myths and misconceptions that come along with life insurance. All right, in this video, we're going to take a look at why the cap rates on indexed universal life are so low right now. And in order to do that, I'm going to do what I normally do, which is focus on the basic fundamentals of life insurance so that you have the tools to figure out these things on your own. In order to help understand why the cap rates are so low right now, I want to start by taking a look at the mechanics of how the interest rate caps are calculated on an indexed universal life. And once you understand the mechanics of that, you'll understand why the cap rates are so low right now. So we'll take a look at the mechanics, specifically why the interest rates are so low right now. And then I'll also circle back and just say or explain why this is not necessarily such a bad thing. All right, before we get started, be sure to like and subscribe to this channel so that you're notified whenever I come out with any new videos. And also, I've got to take care of the housekeeping, which is I want you to understand that there is no advice being offered in this video. No financial advice, no tax advice, no legal advice. And understand that the purpose of life insurance is for the death benefit protection. Any other benefit is purely ancillary. So with that, let's get started. So let's begin by taking a look at what the cash value in a life insurance policy really represents. And that is, it's the reserves that the insurance company uses to make sure that they have enough cash on hand to pay all the expected claims as they occur. And basically, those are all state regulated. The state kind of imposes the minimum requirements that the insurance company needs to keep on hand in order to meet all the expected liabilities over time. So all of the premium dollars that the insurance company collects go into the general fund. And from the general fund, they have to pay expenses, they have to pay commissions, they've got fees, they've got to make a profit. And the money's not sitting idle. So they're basically taking all the money that they're collecting in premium. And once they subtract all the expenses, they're investing that money. And what are they investing in? Well, they're investing in debt instruments for the most part. The state regulates what kind of rate of return that they need to make on the money, so they don't need to hit the ball out of the park. They just need to make sure that they make a nice, safe, secure rate of return. So primarily, they're investing in debt instruments. When I say debt instruments, what I mean is bonds, so U.S. Treasuries, corporate bonds, municipal bonds, preferred stocks. They make loans against real estate, and they've got other investments. But for the most part, it's all safe, secure debt instruments. All right, so let's summarize. We know that the insurance company is taking their reserves and they're investing it in safe, secure debt instruments. And all of those instruments pay interest or dividends of some sort. So by the end of the year, the cash has grown. And really what the insurance company is doing at that point is comparing where they need to be as far as their actuarial growth rates to keep up with their expected liabilities and how much they actually made. And any extra is credited back to the policy owners in the form of a dividend. So one of the reasons why dividends are not taxed is that they're treated as excess premium. So really it's just the overage that you paid being returned back to you. But in the case of most policies, that cash can be reinvested in the policy itself to increase the policy's cash values. So one way that you can think of the dividend on a life insurance policy is as a return, or the net return on the cash value of the policy. So up until this point, I really haven't mentioned whether we're talking about index universal life or whole life. Up to this point, this is how all insurance companies work. They all invest their money in pretty much the same underlying assets. They all have expenses, they all make money, and they all credit it back to the policies in one way or another. So where index universal life and whole life really differ is in how that divisible surplus is credited back to the policies. In the case of a whole life, as we understand or know now, is that it's paid as a dividend. However, in the case of an index universal life, they take what they would have paid as a dividend and they go out to the index options markets, and their hedgers invest in call options, buying and selling call options, to basically capture as much movement in the market index as they can get with the money that they have to spend. So here I just want to explain the goal of an index universal life insurance policy is not to match the performance of the underlying index. It's simply to earn a premium over what they would have paid had they just paid that dividend in the first place. So they wouldn't be doing this if they didn't think that they could earn a premium over what the dividend would have been. So I want you to understand that. The goal is not to match the index performance. It's simply to earn a premium over the debt market rate of return. So why are the cap rates on index universal life insurance policies so low? Basically, it's because the hedgers don't have as much money or budget to play with. Because the interest rates are so low right now, they just don't have the same amount of budget, so they can't capture as much movement in the market, so the caps that they can offer are much lower. This is a graph of the Moodys corporate bond yield. It's for AAA bonds, and it extends out from 2012. And you can see that we are pretty much at the lowest point in the last 9 years here. And rates have been not steadily falling, but you can see there's a trend downward in interest rates. So the reason why cap rates have dropped is because they simply don't have as much money with which to buy and sell options and offer a higher cap. Now, just a few years ago, the cap rates on index universal life were in the 12-13% range. And this is for an S&P 500 index, and it's a 1-year point-to-point strategy. That's kind of the benchmark of a lot of index universal life policies, although they do have interest crediting strategies tied to other indices that have even higher cap rates. But most of the time, when I'm referring to cap rates, I'm thinking of the S&P 500 as the benchmark index. And just a few years ago, the cap rates on the S&P 500 1-year point-to-point were in the 12 to 13% range. And you can see that just a few years ago, the Moody's corporate bond yield was in the 4 to 4.5% range. But now that we're down in the 2.5% range, the hedgers have about a little more than half the budget with which to do their hedging. So the cap rates, the amount of movement in the market that they've been able to capture, has come down from that 12-13% mark down to currently like 8.5%. I'd say is the average across policies nowadays. So that's the reason why cap rates have come down. The insurance company is not trying to screw you. They basically, their holdings aren't earning as high a rate of return, so therefore the hedgers just simply don't have as much money to spend. Now, I mentioned why I think this is not a bad thing. I didn't mention why, I just said that it's not necessarily a bad thing. Just keep in mind that interest rates are down across the board. So dividends on whole lives are coming down. If you were investing directly in bonds yourself, yields are down. So it's just the state of the market today. But the reason why I don't think it's necessarily a bad thing is I want you to pay attention to the fact that the goal is to capture a premium over the debt market rate of return. And that premium remains relatively constant. So in order to help illustrate that, I want you to take a look at this slide. And I've got two tables on here, and I want you to pay attention to the one on the left first. And what you're looking at is a table showing the year-by-year changes in the S&P 500 index itself. It's not the yield on the S&P 500, it's just the year-to-year change in the index itself. It doesn't include dividends, it's just the index itself. And I recently did a video on why IULs don't include or the dividend yield on the stocks, on the stock index. Sorry, I can't talk there for a second. That link will be up above here, so I'll take a look at that if you want more information on why the dividend is not calculated, but I would think it's obvious from this presentation. All right, so taking a look at this graph, on the left side is the year-by-year changes. And I've got about 31 years of index values there, index changes. And what I want to do is show you how a hypothetical indexed universal life with a cap of 8.5% would have performed over that time period. So it's very easy to write an Excel spreadsheet, an Excel formula to track it. So if we look at the very first year, we can see that what the market did and what the cap is. So if the market return is higher than the cap, you get the cap. If the market rate is between the floor and the cap, you get whatever the market change was. And if the market went down, you get the floor. So it's very easy to write an Excel function that does that. So in the second column, we've got the year-by-year changes or the hypothetical interest crediting that an IUL would have made that year. Now, I think we all know that we can't just simply add up all those returns and divide by the number of years and calculate an average. The only way to truly analyze interest rates and yields over time is to look at the annualized rate of return. So in order to do that, I'm showing my calculations here. I'm starting with $100 and I'm adjusting that $100 by the year-by-year change in the market itself, the market change yield, as well as how the IUL would have performed. So we can track what $100 would have done over those 31 years that I've got there. And if you direct your attention down to the bottom, here I've got a summary showing what the annualized return is. And again, an annualized return takes into account the ups and downs of the market as well as the compounding interest. So if you start 5 years ago with whatever value that is, and you go up, down, left, right for those 5 years, you finish at a certain value. What rate of return would you have needed to make in order to get from point A to point B without all the volatility? That's really what the annualized rate of return is. And maybe I'll just do a video on that here coming up as a way to explain, because it is a very important calculation. But as you can see, with the unrealistic assumption that cap rates are 8.5% or were 8.5% for the last 31 years, you can see that the hypothetical IUL would have yielded anywhere between, in that 5 to 6% range. Now, again, I want you to understand this is all hypothetical. This is not what your IUL is going to make over the next 30 years. It's just the worst case, assuming that today's low interest rates, which result in really low caps, if we take that really low cap and we apply it backwards for 30 years, this is what the performance of the IUL would have been. And you can see that's really not bad considering all the other options that are out there today. Now, if you direct your attention to the right side of this slide, and I've got this graph, this one is showing the cap rates from a few years ago when cap rates were 12%. if we take the same approach and we apply the 12% cap to the year-over-year changes in the S&P 500 values, you can see that the resulting annualized returns down at the bottom are significantly better. And it's not to say, again, that this is a projection of what you would expect to get over time. It's just, had the caps been at that level for the last 30 years, this is what it would have looked like. So it's purely hypothetical. But what I really want you to understand is that looking forward, it's fair to say we're going to experience a lot of interest rate volatility. I mean, interest rates are not going to stay as low as they are right now. I mean, if you look at this graph again, we can see just in the last 9 years, 10 years, how much interest rates have changed. And if we go back even 30 years, we know that the rates have been on almost, I don't want to say steady decline, but they've been trending downwards since the early 1980s. So we're just at the culmination. I hope we're at the culmination. Interest rates hopefully can't go much lower. But I guess that depends if you're investing money or borrowing money as to how you feel about the low rates. All right, so why did I go to all this trouble of showing you the Moody's corporate bond yield and what the hypothetical IUL would have earned over the last 30 years? I want to give you an idea of what the premium is. When I say premium, I'm not talking about how much premium you put into the life insurance policy. I'm talking about when the hedgers invest that dividend, what they would have paid as a dividend in the index options, their goal is to capture a premium over the debt market rate of return, or over what they would have paid had they paid a dividend. So what can we expect there? Well, here, if you take a look at what the trending yield is, and I think of the Moody's corporate bond yield as a proxy for what insurance companies are making on their holdings, assuming they were holding all high quality AAA rated debt. And we know that's not the case. We don't know what insurance companies are really making on their money. Some might have riskier portfolios, which I'm going to circle back to here in a minute. And others might have safer portfolios that earn less in interest but are safer. So we don't really know, but we can take a look at, we know what they're making. We know what they're making on their money. That's basically the proxy of the Moody's corporate bond yield. And we can also take a look at what, given the cap rate resulting from that yield, if we look back, we can figure out what the annualized rate of return is. So we can kind of take that higher return, say 5.5%, and subtract out the interest that they're earning, 2.5%, and we know that there's about a 3% premium that the insurance company is able to capture if interest rates were to if everything were to stay static for the next 30 years, or looking back over the last 30 years. And one of the things I really want you to understand is that premium, for all the years that I've been doing this and tracking this, it stays relatively constant. So as interest rates have fallen over the last few years, that math still works out to calculate just about the same level of premium every time you look at it. So that's the upside. Whatever you're doing, rates are down everywhere. So here, we know we can at least safely put our money into a policy and earn better than what we would have made had we put our money into a similarly designed whole life policy. So, all right, I said I was going to circle back on something. I kind of forget what the point of that was. But one thing that is unique about Index Universal Life is the insurance companies know that they can capture a premium over the debt market rate of return. And since they don't need to hit the ball out of the park, one of the neat things that they can do is they can reduce the risk exposure on their underlying reserves, meaning investing in safer assets. And by doing that, and knowing that they're going to hedge and capture a higher rate of return, they know that they can still earn a premium over the debt market rate of return or dividend, but they can do it without taking on as much risk. So you might find some companies that are offering maybe a little bit lower cap. I mean, if you're out there shopping for an Index Universal Life and you're comparing cap rates, one thing I really want you to keep in mind is that two things. One is the insurance company may be offering a lower cap in exchange for understanding that their yield on their underlying investments is that much safer. But two, a lot of times there's companies out there that, this may be the first or second year that they've been offering an index universal life, and they may not know what they're doing yet. So you really got to ask yourself, if company A is offering 8.5% and company B is offering a 9% cap, why is that? If we assume that everybody's making about the same rate of return on their underlying holdings and they're buying options in the same options markets, how is one company able to offer a higher cap than another one? So either they don't know what they're doing, or they've taken on greater risk in their underlying portfolio and they've got more money to spend on options that they can use to purchase a higher cap. So just understand the trade-off and understand what's at stake when you simply shop for IULs based on the cap rates. All right, so what I have on screen right now, I went online and I grabbed the annual reports that are publicly available from MassMutual, which has one of the highest dividend rates in the industry right now, and one for Securian, in the underlying company that I like is Minnesota Life. And just take a look at the breakdown of assets. And one thing that you'll see here is if you look at Minnesota Life, who's a company who focuses primarily on index universal life. They offer whole life products, but they're mostly known for their index universal life. And MassMutual, on the other hand, is known for its high dividend rate. It's a whole life company that offers a nice dividend yield right now compared to a lot of the other companies on the market. But take a look at the quality of the debt. I'm not denigrating MassMutual, but just, you can see here with your own eyes that the amount of high quality debt in the holdings of Securian is much higher than that of MassMutual. So, in any case, I wanted to show that to you just to kind of highlight what I was talking about, meaning insurance companies can manage their risk in their portfolio and use the premium that they can capture via an IUL in order to make their underlying reserves that much safer. So let me just kind of summarize everything for you, just kind of bring us, wrap all these scattered thoughts of mine up into a cohesive message. The purpose of this video was to explain why the cap rates on index universal life are so low right now. So we have to understand that the insurance company is basically taking what they would have paid as a dividend, and they're going out to the index options markets with the goal of capturing as much movement in the market index as they can get with the money that they have to spend. And because interest rates are so low right now, they don't have as much money to spend on hedging activities, so they can't capture as much movement in the market. So that's why cap rates are so low. And the reason why I don't think this is necessarily such a bad thing is that the premium, the amount that they can do better than the dividend rate return, it remains relatively constant. So even though interest rates are down, they're still earning a premium over that lower underlying interest rate. So given all the options that you have to do things that you can do with your money, I think it's still always a good time to put your money into an index universal life, knowing that you're going to be able to capture a little bit of a premium over the debt market rate of return. So with that, I'm done with this video. If you're hungry for more information, you can go out to Facebook and look for the Double Play group. And that's a group that I put together for my clients, prospective clients, but it's a place where you can ask questions of people who are actually doing this and not have to talk to a life insurance agent. And then I post links to all my videos there as well. So My website is innovativeretirementstrategies.com, and just like my videos, these are not salesy, and my website is not full of vague salesy information. It's high quality content geared towards answering every question that you can possibly think of regarding buying life insurance. So understand that my goal with these videos, my website, the information that I put out is to help you make an informed decision about buying life insurance. I want you to have everything you need to feel good about making that decision to buy life insurance. So with that, I'm done with this video. Be sure to like and subscribe so that you're notified whenever I come out with new ones. Share this video with all of your friends who you think might be interested, and I'll see you in the next video.